Okay, very well. Welcome, everyone. Thank you for joining today. I'm Giuseppe Basile, and also known as the FibStalker, and I will be your host today. Thanks for joining. See a few people there. Welcome, Pantelis. And thanks for the information you sent. And today, I'm not going to offer a lesson, a CMT level 1 lesson. We will get into straight in the market, and we're going to review a few pairs, pound pairs, and after that, I'm going to answer questions. If there are any questions, there'll be a Q&A session. And we will look at some of the trading opportunities. So this show is actually in 3 different parts. Okay, so let's start. Before we start, if you are watching the recording of this video, I want to remind you that trading management, risk management in trading is trader's job number 1. So if you will please stop the recording here and read, make sure that you have read the slide here. So I'm not going to talk about myself. You can find a lot of information myself in previous videos, as well as the videos on FS Trade as well. These are some of my research papers for the IFTA and as well as the Canadian Society of Tech Analysts. We were at the Morning Show. Just want to remind you that in mid of October there'll be our national conference. If you are in Toronto or in Ontario or even in Quebec, I warmly recommend you'll be there. We will have Andrea Unger and Leon Toei, who's this gentleman on the left here. He has 55 years of experience in tech analysis, so I'm actually looking forward to meet him and ask questions. All right, so let's start with the first part here. If you like what you see, please you can tweet it on using your account. Thanks a lot if you like to do that. All right, so the objective of this webinar, as we said, is separated in 3 parts. In the first part, we're going to review these 5 markets: pound versus US dollar, pound versus Japanese yen, pound versus Australian dollar, then New Zealand dollar, and Canadian dollar. So these are basically European Pacific plays here. In the second part, if you have any questions, I'm going to answer your questions on any pairs you might have. And finally, we're going to review a couple of trades opportunities for this week and next week. Notice that I won't have the first part today, which is the educational part. Usually I have an educational part, which is also valid for the CMT level 1 exam review. And next week, I'll resume this educational part, and we will look at the MTA view on candlesticks. All right, so you'll find that next week. You can find me on FibStalkerTrading.com, and I've also have a coaching program that is coming up end of October. If you're interested, you can write me at FibStalker@gmail.com. You have the email here. Okay, so pound pairs review. Let's start and get into it. So I'll switch into my chart. So let's start from pound versus US dollar. What is this market doing? So I will switch on the trading platform here, and I use 2 main models. Well, I use more than 2 models in reality, but in this show, I actually show 2 models: a smart money model and a dump money model. And as you know, and those of you who know me also know that I like to look at the market starting from a very large time frame where we can actually see what is the main trend and where the market is going. So for we're concerned, the move that we are seeing recently, of course, a lot of people will invoke or would invoke the Brexit. The reality is that the way smart money was positioned in this market was already well understood and known well before this market actually before this market went through the Brexit. And I'll show you how technical this market has been before and through the Brexit as well. When I say technical, I mean that this market respects models that we use to model the activity of smart money, particularly the activity of algorithms. And we had this measure move here, which even if we identified it after the fact, that first test in 2009 here, this area came into play again, basically 5 years later. And price found a resistance around 169.60 area here. And with that resistance, we also had a target that I'm going to show you here, and that's the target in 119.07. Now, smart money in a very, very large time frame, they're actually trying to target that level. If the level seems extreme to you, you should just look at the 2300 pips here. This market has lost in a few months here since the Brexit event. Okay, but the technical character of this market does not end at this very large time frame. In fact, this market has been very, very technical, not only on the monthly time frame, but also on the weekly time frame. As you can see here, this market found participation at 59.89, and then it continued lower into what? Into that first target. And we should not be surprised that this market has found participation at that target, the 139.32 here. This is well before the Brexit event. What I like about this market, and the reason why I say that it's a very technical market, is that in one day, the day of the Brexit, we saw this market trading the same day, trading the next measure move, so the next setup short here, which was identified by the area starting at 148.85 and up to 151.31. And as you can see, price stayed into this area. This 1% level was never breached. And look at what happened in one day. The market actually set up at 148. In the 149 area here, and then went in one day into its first target. Okay, and this is pretty unique. In fact, I can say that this is the first time in since I trade that I saw this kind of behavior. The point is that the market has not stopped there this time, has not retraced another 50%, but has went well below that first target, and it's pointing into 125.53, and that's the reason why the title of this review, it's pound targeting 125.70. The reason it's exactly this one. It's targeting a level which is just above this second target here, and that's the reason why we are seeing this market continuing lower. You also have to keep in mind that on the larger time frame, there are monthly participants, smart money, who are interested actually in keep pushing this price lower into the 119.07. So in reality, reaching the second target, 125.70, would be a way to help, the lower timeframes are helping this price into a larger target. Okay, so you should not be surprised to see the market at 125.70. In fact, if you are short, you should still keep your shorts. There's no reason to buy back at this stage, and I suggest at least you partially buy back at 125.70 or 50, because this market on the smaller time frame, or I would say weekly time frame, has the potential to retrace. Okay, and so that retrace though will not come until we're going to see 125.70, 125.50 here. And if we get to the second target, let's say we touch it to the pip, whatever low we trace here, I would maintain that this market can actually see some profit taking and go back to the 131.90, 131 area before continuing lower into 1910. Okay, so this is my view on this market on this very, very large time frame. When we look at how dump money is actually playing this market, it's pretty interesting because what we see here, we saw participation from dump money within that area, where we also had smart money. Actually, dump money started selling this market at 157.35, but I think we know that the decisive move will only come when smart money will have the highest volume to sell this market, and that happened at 158.77 here. That's when that decisive move started. And again, the market was brought higher due to intervention of that money on the smaller time frame until the market went again into that short value area of dump money here, which now was aligned with participation of smart money, and that's what has allowed this market to keep moving lower. Interestingly enough, smart money, monthly smart money, came in to sell this market the day of the Brexit, and again, weekly smart money came in. Dump money came in again to send this market lower. But in alignment with the setup of dump and smart money that we saw on the day of Brexit. And this is a commitment that shows committed both of smart money and dump money in selling this market. And when you have this kind of alignment, obviously the probability that the market will continue lower is higher. So what comes next in this market? How are we going to tackle this market to try to profit from this market? If you're short, you should stay short, but not, as I mentioned before, below 125.70. That's my suggestion there, and this is not a recommendation. This information is provided for educational purposes only, just to show you how these models are indeed capable of capturing something which is fundamental about how the market behaves. And but obviously, so you can use these models to try to take decision. Of course, risk management is again treated job number one. And for example, when I have these areas of smart money, when I participate, for example, in this case, I did not participate, and the reason for that is it was a news day. So news day. The market can actually participation in the market can actually temporarily bring the market in a situation where algos are not capable of handling the volume. So this market could have moved higher. However, once we saw that it's stalled here, then there were other techniques like the FibStalker timing that can be used in order to actually time the entry in this market. However, I never participate during news, and that's a rule I have. And I don't think it's needed because when the market is calm, we'll just follow dump and smart money. So how do we tackle this market? This market, as mentioned before, is actually it's actually it's looking for a target, which is a target below here, and that's the 125.50 area, 70 area here. So until the market gets there, this is a short position. Once the market got there, I'm going to look for a reaction, and as the direction of this market is still down, I'm not going to buy that reaction. Just want to see price moving into an area that could be 132, 131, 132, and that would be again a weekly a dump short value area, and that's where I would be interested in selling this market. On a smaller time frame, you can try to buy this market only after the second target has been hit. It's a weak signal. You can see that a weak signal. The market could just continue lower. So I'm looking for a retrace into an area where I can have a number of participants, strong participants, that can keep pushing this price lower. Okay, and the final target against 119.50. That's the area. Okay, so this concludes the review of the pound versus the US dollar. Again, target 125.70. Okay, in the next video, I'm going to review the pound versus Japanese yen here, and there is a potential reversal into the 136 area, and I'm going to show you why I believe so. So when we look at the chart, this is what we see here. There is a pound versus Japanese yen. And again, when we look at the two different models, I'll remove one of the two models here. And this market has been trading in extension. While the pound versus US dollar has traded, was trading in a traditional measure move before. Also, this market is trading traditional measure move. The point is, in the pound versus US dollar, we had a sequence that was respected. What is interesting here is that this market was actually indeed respecting a sequence here, and I'm going to show that sequence to you. And that was highs to lows here with participation in this area, 163.47. This is a traditional measure move, and price got into that first target, and there was a reaction. The point is that while the pound has respected the 50%, during that reaction, algos and smart money in this market, during that reaction, was not capable of holding this price below the 156.86. Despite that, this market has continued lower, and actually the market can now be modeled in a number of ways. We can actually use the highs to lows here, but as you can see, there was no participation, that the market could not make it there. So we cannot say that this area was an area where shorts have participated. On the other hand, what we know is that once we traced this, we know that the market anyway became extended, and we can try to use the low that we have here to lows. And when we do that, we see that shorts were not inclined to pick up this market. Now, what's the meaning of this? Well, this market, it's not reacting to a valid 50% level. This market reacted on the short side to a valid 50% level, and that's the reason why this market continued lower. We had a measure move here, and this very large measure move, which was known basically 3 years before this market came into this area where potential short participation could have been encountered. In fact, it has been encountered here in this area and in this area here. So the this market has continued lower. Now, apparently, the sequence here, the sequence of measure move that models algos has been interrupted here, not necessarily on top of an area where there's a strong reversal, because there's no area of participation below this market, but this could actually indicate that we could see some sort of reaction here. Now, an help is given when we overimpose the other models, and again you can see the participation that came in these short value areas here. And obviously, as I always like to say, the participation of in area where also algos and smart money are participating are much stronger than and produce much more durable moves in the markets when the participation comes from levels that are watched by algos. And this is pretty interesting because it also shows another reality of modern market, which is the fact that when algos or smart money participates at larger time frames, then the lower time frames will align as well in the direction of the larger time frames, and will try to push price into the target areas, as it happened here, and then it's continuing to happen. So that's very, very important. So it doesn't mean that dumb money, dumb value areas should not be considered. They should be considered because they can give quick and good trades, for example, reaction in this area or reaction in this area when the market actually participated. However, in order to understand whether the market can put a continued move, we need to look at how algos are interacting with the market, how algos are actually pushing that market around. Now, what do we see in this market? What we should anticipate and how we can take advantage of this. So if the weeklies are not interested in pushing this price lower, and they proved it here when this market actually pierced to 142.96, they proved that they were not in control of this market. What is in control of this market is the dumb money area that is selling this market in the daily value areas here. And as soon as and when this market comes back into the weekly value area, you can see that there is a sell-off. However, that sell-off is not sustained, and the reason why it's not sustained is that smart money has done its job. You know, they took profits once and twice, and they're done now. They are waiting for a new setup, and the new setup that we're looking for was the lows to lows, and they didn't show up in a way. Now, to me, that indicates that it's possible for this market to rally into this weekly value area and up to the 140.33 again, and we will see whether the bears, the smart money bears will be willing or capable of picking up this price. So what we're seeing at the moment is a new reaction into an area of potential participation. So for this, if you're long this market, you should probably take partial profits at 136 area, and then probably remove the position if you make it there into the 140.27. And I'm telling you here the reason why. So that's the reason why we look for a potential reversal in the 136 area, because in the 136 area we have the start of the weekly value short area here, and a little bit higher we have the start of the smart money area where smart money will come in to sell. All right, so this concludes the review for the pound versus the Japanese yen. Okay, let's move to the next review. I'm going to review for you the pound versus Australian dollar I don't have targets for this. We will find them in the review as we go. And the pound versus Australian dollar is it's quite an interesting market because actually it's probably the market that has the highest volatility in the forex markets. The market that moves, I think, an average 104, 106 pips per day, which means that there are days that are special for this market. So a lot of volatility. Obviously, volatility is not all, because if you manage risk properly, your risk management is adjusted to volatility, which means that probably the kind of return to risk that you obtain are probably similar, unless you work on very small time frames and you take positions on very small time frames, which is something that I don't do consistently. And because I like to trade on the 4-hour daily and wait for position to set up on those time frames and then come down to maybe the 60 minutes, rarely the 5 minutes. But that's possible anyhow. So when we look at this market, the pound versus Australian dollar, we see these large moves, 1 day or 1 week moves, and again, that's because this market has the highest average pip move, highest in among forex pairs. And based on the data I have, if we don't have higher highs here, we would say that this market is moving laterally. Why is this market moving laterally? Well, because actually bears were not capable of holding this price down, and bulls initially they tried and they succeeded, but then they failed. Right now, obviously, this market has a bearish bias, and the reason for that is that monthly bull and bears might not have their ideas clear, but I can tell that the weekly bears have their idea very, very shooting up and clear here. In fact, they actually shorted this market at 202.60 area, and the 207.23 held, and this market was pushed in the last few months here into an area of target to 173.82. This area of target is actually an area where you can see this market actually moved around for some time, and the reason is that there was some profit taking here that has pushed price higher, but nevertheless, this market is continuing lower. One case we could make is that this market is actually, again, I mean, has behaved very technically here. When you have the aggressive move, lows to lows here, as you can see, we got participation into this area, and again, profit taking coming right at that 167.40. And the reason that happens is because there are indeed algorithms who are actually watching this market. Now, this market also failed the sequence here because, the low to low here showed that the bears were not capable of holding this price, which suggests a number of things here, and particularly the potential for this market to reverse drastically, either at 163.70 or lower, close to this previous size here. But there are previous size also around 163.70. So this market is indeed on a larger time frame, still in a lateral move, very large lateral move. In fact, I don't use trend lines, but if you wanted to model a lateral market, you would do it using trend lines, and the reality is that these trend lines only help modeling internal conditions of the market, where bulls and bears are not committed, at least on the larger time frame. Okay, so when we go back and when we go down to the daily, and we overimpose the other models, we can clearly see here participation in daily bear daily bearish value area here. And then again, when the market made it into the weekly, again, we had some sort of participation there, which is pretty interesting, 177 to 167, it's 1,000 pips here. Okay, so it's very important to monitor these areas, particularly when they are in line with smart money. Now, these daily short value area here was indeed aligned with the daily extension short here, and so it was just a great opportunity, and there was participation here with a clear target and the possibility to bring price to that target and take profits or even partial profits before this full retrace into that area. But when the market came there, although the smart money was not supporting shorts any longer, there was very strong weekly value area short there that actually kept pushing this price lower. So as you can see, some of the reason, of course, I mean, these two models do not model 100% the behavior of the market. I think that no model can do that, but it's good enough and shows how the ball in a way goes from the smart money area field to the dump money area field, and they kind of exchange it. Sometimes they agree, so the market moves down very, very quickly and strongly with little retraces, which implies little risks as well. And sometimes they do not agree. Well, if we look at this price, initially here we had the market reacting to the this area here, which was the next measure move in the sequence here. However, it encountered a bullish daily value area that actually pushed this price higher, above the level that algos were looking at, but into that the value area there. So that short value area. So that's good enough, and is actually suggesting that could be participation. That if there are ways to procedurally time these areas as well, so that we can take advantage of that. All right. So what can we anticipate in this market? 163.60 and 158.40. This could be two areas, and be careful in this market. This market could actually put up brisk profit taking, very, very brisk. And don't forget, and there could be something like this, don't forget that this market can move a lot, 188 to 119.91.35. So we talk about 250 pips in one day here. So that's the kind of moves that we can get in this market. All right, and this concludes the review for the pound versus Australian dollar. Okay, so in this video, we're going to review the pound versus New Zealand dollar. And I don't have specific targets for this market, but we are going to review some of the levels of interest as we review this market. So let's switch to the charts here. And of course, we always like to start from a larger time frame. The larger time frame is the weekly time frame here, and we had of course a reaction that does not come from random areas. So 50% of the move that we saw starting at the beginning, first quarter of 2013 here into third quarter of 2015 last year. And then we got that participation. This is a pattern that we see often in these markets. I mean, all the markets related to the pound. And then we also saw, when we see this large participation, we also see and look at participations in the inner trend. And usually I tend to not consider wicks, very long wicks like that, because they show a participation that was only temporary, while the participation from this high is actually more significant, and in fact it models the move in this market. This market, however, became extended, and again we have to resort to other models that I present in my FibStalker Method coaching program, that allows us to model the inner moves of these markets. And you should not be surprised that extensions always try to bring price into that first target, and around that, first and second target, and around that second target, there might be a reaction. So, and sometimes algo, and then these are situations that sometimes you're able to identify before the fact. Other times we are not able to identify them before the fact, but they still give us information. For example, the same anchor was reused here to model participation, and 220, and even though we don't know this before the fact. Imagine before the fact, before the fact, we don't know what this market could do. In fact, the first thing I would think of is, a participation at this lower level. And in fact, there is some sort of participation at that level, and it even gives us a freeze trade. The point is that that's not the final level we're going to use, and that's why, as we don't know what the market is going to do, we have to have models that allow us to take advantage of opportunities by controlling risk. And in this specific case, the market reacts to that level, risk-free trade, it gets back into the level we are stopped at from risk-free trade, and then you have to get involved again. Now, would you do on this date here? Yes, because this was well before the Brexit, but even if you were not able to do that, it's always important to know this information. Look at what this market did. Went to the first target and second target and went well below the second target. And then we get information by just modeling the sequence of measured moves. And this market came back to the pip into the 190.48, which is suggesting us that what? What is suggesting us? It's suggesting us that this market wants lower. And this is all supported by how the larger time frames are actually trading and looking at this market. All right, because when we look at this very large time frame, we have to go lower to see where this large time frame has targets. And this target, imagine this target of 242.26 in this market as a target at 146.46, basically 10,000 pips below, which might be processed in maybe 2 years or 3 years. But still, we know where this market is going. And it's not surprising, also from a fundamental point of view, right? Because UK might not be in that, might be in a difficult spot, more from a foreign exchange viewpoint than an economics or economical viewpoint or political or geopolitical, because I believe personally that will benefit from Brexit in the medium long term. But obviously, in the short term, the currency is suffering. The point is that it's all aligned. It's like these guys here, I wouldn't say they knew, but they took a bet that actually was confirmed by Brexit and is actually potentially pushing price into that target at 146.46. So it's very interesting. And here, what we see now is that we see a large long-term target here, 146.46, as we say, 10 thousandths pips, off target. It's this level here. But this move lower can be decomposed in a sequence of moves. And what we're seeing here, it's an extension lows to lows into 171 and 160.90. And the first target is 171.01. So as I was saying before, when I mentioned, sorry, just a little digression, when I mentioned the pound, from a fundamental point of view, you also have to consider the other pair, the New Zealand dollar, which is one of the best performing, I would say, currencies as well as countries in the currency war. So obviously, when you put something that it's bad, or at least temporarily bad, and at the denominator you have something that is, is doing relatively well, obviously you have a move that can continue lower. So in terms of targets, you have to look at 171.01. And the second target would be 160.90. All right, so this is an extension. There is the possibility for this market long term to move into that level. Now let's look at what our trend following system is telling us. Well, the system is telling us that there are areas here, particularly the closest area is the 190, is this 182. So should the market come back into this area, this would become an opportunity to sell this market into what? Into 171, but possibly even 160.90. Okay, and the reason for that is there is a long-term target at 146.46, believe it or not, and there is a weekly participation area that was confirmed by price action as well at 190.48, which has the potential to bring price lower into 171.01, 170.69. So I hope you appreciate how by combining these models, you can actually come with trading plans and, most importantly, targets where you can that are there because algos and smart money participate in a certain area, and then they'll do whatever they can in a smaller time frame to try to push this price into those target areas to take target, okay, to facilitate taking targets. So this is what we can see on this time frame. When we look at the daily time frame here, we don't have a lot of information, although we can see that clearly daily participation came in some of these short value areas, and these were opportunities as well, only when they are very clear, when these moving averages are not inclined or there is uncertainty, you just leave it alone. And you just wait either for a level which is watched by algos, and these levels are also on a smaller time frames, of course. And or you wait for a value area on a larger time that gives you more confidence in the move. And again, when we look at this market and we look at the we look at this move, if we look at this move and we can only identify it after the fact, there are other ways that take into account also how that money is positioned in order to enter into these trades. And so on the daily here, any rally that brings price above the 79 area here into the 183, although it seems a long reach here, this would be a great opportunity to sell this market in alignment with the positioning of the smart money. Okay, and this concludes the review for the pound versus New Zealand dollar. Okay, so next I'm going to review the pound Canadian dollar, and again for this market I don't have targets, but we'll be looking at the charts and see what the charts are telling us, and where this market could actually go. As you can see from the traces already have on this market, although I'm going to repeat the analysis here. We have an extended market that actually is trading in extension on this weekly time frame. This is a notable anchor that we can identify before the fact, and we use also pace and other information the way the market is moving. And look at the beauty, and you recognize that these traces are correct when you see the kind of behavior you get when this market reach first and second target. First target here, there was, this is a weekly chart. During the week, there was some sort of participation profit taking. That was not enough. This was also an extension, so we know that extensions tend to move to extended targets, and that's the 167.20. Now look at the beauty here, how this profit taking took place. And when the profit taking takes place like this, very close to this area, that's a confirmation these levels are correct, are the levels that indeed the smart money is looking for. Okay. Now, again, every time we have a target, we also keep modeling this market, and this was a beauty here, very technical market, came into the next area of potential short, gave two foolish trades, and then it stopped us out. Well, it gave one risk-free trade, it stopped us out from that one, and then a second one. And the only problem here is that the market came back after moving relatively a lot, 173, 174 into 167. So we're talking about 700 pips here, only to come back into that area and then start the move again. If you were quick or you were taking partial profit, you could take profits near previous lows. However, what I'm more interested in this market is where the targets are. If you're short this market, you should stay short into 163.63 and even 158.26. Why? Because smart money and algos are clearly pointing lower here. And if we had any doubts, when the market came back again into that area, the 173.74 area, this market was sold again. Sold once, twice, three times, four times in this area, and then again when he came back, bears were still there trying to sell this market 5 and 6 times, and obviously at some point bulls gave up and there was no one else buying. This market could only go down. Now, as I mentioned before, and this is again very important, whenever there is participation in one time frame, a large time frame, the algorithms which actually work on all time frames will actually help them move. Okay, which means that the sequence on the smaller time frame will actually keep pushing that price lower, and that's exactly what we see here. You see the market came into the 50%, went into the target. It might be maybe again trading, and there will be two options here. Either the market trades again into the next measured move or just continues lower. Okay. However, there was an opportunity for an entry short in this market, a 50% retrace, right where the highs here are here. So if this market continue lower, on the daily time frame, you're going to look for a short-term target at 165.05. If he comes back, it's going to come back for a short. I don't believe it's going to come back. Well, but my belief is not really important. Because Mr. Market doesn't care about what I believe, and you have to be ready for really for anything with the markets. So here there are two scenarios that we have. Either the market comes back to trade into 116.985 and then continues lower into previous lows and even lower, or market will just continue and then we will see some sort of reaction after it gets below 165.05, 165, and we might see some sort of reaction here that brings price into previous lows for a continuation lower. Why a continuation lower? Because that's what the weekly is suggesting here. The weekly is suggesting 163.63 and even, believe it or not, even lower. Now, this may require a few weeks, even months before we get there. But if you're short this market at 174, you should stay short and try to take advantage of this big move here. All right. And this concludes the review for this market, the pound versus Canadian dollar. All right, so thanks for watching. So this concludes the review. I have a Q&A here, which I will do only if there are any questions. Are there any questions? If I see some questions, I'll do it. Otherwise, we'll scratch this session also because it's 8 p.m. Here in Canada, and I see no questions there. So I want to look at a couple of trade ideas here, particularly moving to another set of markets I follow, particularly the futures. And I want to look at silver. The reason why I want to look at silver is that obviously, if you look at 2 weeks ago, by the way, and also some of the reviews. And if you're not on my newsletter, you should jump on my newsletter because I give some of this review. I do them during the week, so you can go to the newsletter is actually here. Is this here? You can go on the Legacy blog, and on the left side here you find the link. But the reason why I wanted to review this market is that this market has been extremely interesting, technical on the upside as well as the downside. And if you remember it, and it's offering now an opportunity. So we'll need to see how this market behaves. This market traded the 1520, which traded this during the Tokyo open room. We went into first, second target. Next measure move failed, and this market came back into the trend continuation area, which is lows to new highs. And then it actually continued in a very technical way, went into first and second target. Look at where profit taking came, and then it failed again. There was participation initially, and then failed. And now what it is coming? Well, as I said, now how many days? 1, 2, 3, 4, 5, 6. Sorry, weeks 7, 8, 9, 10, 11, 12, 13. I traced this trace here after the this break here, and this was 11 weeks ago. So 11 weeks ago, we knew that this market had to come somehow into 1769. Okay, and that's exactly what happened. It happened yesterday. Actually, it's a weekly time frame. Most interesting is that when this market, we knew that it had to come here. So at some point, it also gave us an opportunity for short, and that was the highs to lows, participation at 1990 area here once and twice into the first target. Okay, and that first target was aligned with the trend continuation area long. Now, what are we looking for in this market? In this very large time frame, the confirmation that there is new participation from longs at this level will only come above 1920. Otherwise, obviously with this, this long distance here, it's not something we can trade. We can take advantage of. All right, so we need to go down to the smaller time frame and see what's going on there, and whether we can infer additional information, try to understand how we can study, how we can take advantage this market. And these are application of my FibStalking timing proprietary technique to enter and time the market. So this is the same trace that we saw on the larger time. So this really doesn't help a lot. So we have to move lower and try to understand what's going on here. And what we see here, we see on the smaller time frame, we see another participation. And as you can see, though, this participation is not, again, very useful because there is a break here. But despite the break and also the wick here that clearly shows reversal emotional behavior here. Despite that, the market continued lower, okay? And it continued lower into the first and second target, and then he hit that larger potential support, and that support it's at this 1770. So even if I don't have it on this chart, but I can add it on the chart for clarity, you can see here that the price is right at that level. That's a target level as well as a potential participation long. How we can confirm this potential participation long? When we look at the 4-hour time frame that we were looking at before, we can, the best we can do on this time frame particularly is to look at a break of 1845, which actually reduces our risk. So this is one way to look at this market. If the market comes above 1845, that would be an indication that there is enough participation from smart money long to actually reverse this trend. Okay, of course, doesn't mean that this level cannot be retested, but it's a first indication that there is enough participation in this market. So that's certainly a level that you want to keep in mind. You can even use that level for trading if the market gets above that level. You can actually go long above, just one pip above the level with a stop below those. Obviously, we can do much better. We can apply other models as well, and we know that there'll be a resistance from 4-hour value bear players here, dump money, short value area here, and so I would actually anticipate a reaction at 1829, which means that if your models or your trading suggestion should go long here, I think your long should end in the vicinity of 1829 here. So I would wait this market to break above 1845, wait for the reaction due to the presence of the dump bears here, and then wait for another retrace on the downside, and only after that actually buy this market. So this is a market that I would not buy above this level due to the presence of 4-hour bears here, but I will just wait. If that is broken and the market comes back, whether it prints lower lows or not, the next reaction higher, that would be the place to buy. So this is a first trading idea here. The SP 500, which we are following, this market, it's currently moving laterally. There is a bullish bias here. I'm not going to repeat the analysis. The analysis on the weekly time is not that different from the analysis that I did 2 weeks ago. And what is interesting here is that we are seeing bulls participating on the long side on the daily time frame here, and we can see from the fact that they actually bought multiple times this 50% level here. So basically, what we saw here, what we are seeing at the moment is that the bears sorry, the bears initially actually have held this 2142, then they actually broke it, and now we are seeing the bulls. Sorry, let me repeat here. So the bears initially held this level, and then they broke it. But the bulls are showing they're holding this level now. If this market comes below 2127, this would be a confirmed lateral move, which is more of the same that we're seeing here. Okay, and we cannot say that this market is going to correct here. Okay, so the observation here is that if this market stays above the 2128, this is a long opportunity again, at least for a trade within this area here. And when we look at the other models, we can see that they're not very decisive. I mean, the daily is not decisive. The weekly obviously is supporting this price, and we can see this clearly on this chart. The weekly, the market came into this value area here, and then it was actually pushed higher. But we know that algos are not there. Algos participated in this market, pushed this market in this area, which is the 1986, pushed this market higher into the first target, and that will come in action again only if the market actually makes it to this larger monthly value area. Why? Because the next measured move in the sequence is 2020, and we mentioned this level again already a few weeks back. Okay, so long value area here, long weekly value area, holding price higher. The algos are neutral on this large time frame. They will only come into play if this market breaks into 2020, and there will be the monthly value area long plus the participation from algos within this area to keep moving this price higher, or attempting to do that, and that's the projection if this market corrects in the coming weeks towards the November elections here. And that's seasonal, but doesn't mean that it happens every year. And so we will see how this market plays out. So if we have to look at this market for opportunity, the opportunity is to trade long above 2136 and below 2130 here, 2126, 28. We could see this market moving lower right into this piercing into this value area, which could still push price higher, but at some point that effect will end. And and if that's the case, we might see 121.40 to start acting as a resistance again. Okay, so that's the area where we want to short the market once we have the proof that there is no longer participation from the bears here. And I would anyway anticipate another reaction higher if this market moves lower before we can actually get into that 2020. All right, so this is it for today. I hope this was interesting, and this concludes the review of the two trade opportunities here. And again, you can find me at FibStalkerTrading.com. I have a FibStalker Methods Coaching Program, which is the 5th session of this high performance program. It's starting at the end of October. If you're interested, you can drop me an email or just look at the information. Also running a 10% discount till Sunday. If you're interested, just let me know. Okay, so thanks a lot. This concludes this webinar. Next week, we're going to review, there's going to be also an educational section. We're going to review the MTA Market Technician Association view of candlestick charting, and that is going to be in 2 parts, and it's also valid for the CMT level 1 exam review. All right, so thanks a lot and have a great night. Bye bye now.